Thanks, everyone. I'd like to welcome you here today. As Logan mentioned, I'm Ward Brown. Some of you might recognize me from the videos that we send out where we try to tell you a little bit about what we're thinking about the world. In addition to that, I do the same thing, trying to spread the gospel of Argent, what we're thinking, what we're seeing across any number of multimedia content that we have access to. In addition to that, I work across the different departments, making sure everyone has what they need, from the investment department through making sure if we ever need to buy or sell a security out of one of the portfolios, that it's done accurately and appropriately. So we really appreciate you all being here today. It's a big year for Argent. It's our 25th year anniversary. It's something we're very proud of. Thank you very much. Thanks very much. We're very proud of that, and we're really glad for the year that we're having this year. You know, Steve Finerty informed me that we've been doing these investment outlook luncheons for 20 of those 25 years. So this is about the 40th time that we've put these on, and this is a really good year for us to be doing it. We're very glad for the way the market's acted this year. It's been an extraordinary year for the market, and I think one that has ultimately been a lot better than what people were expecting, just given all the things that are happening out there, and particularly in light of the year that we had last year. In addition to that, and I think much more importantly, has been, as Logan mentioned, the really extraordinary year in the Argent portfolios. Relative to our benchmarks, Argent portfolios are not only positive, but they are beating their benchmarks substantially. And I don't want to make myself sick fawning over the investment team, but it's historically good relative performance, and we're very proud of that. We have a really good program for you today, a really good discussion. The theme of the discussion today is the more things change, the more they stay the same. And no one is more adamant that that's true than Steve Finerty. And you'll notice that Steve, from then to now, not a thing has changed. And as a matter of fact, he's still wearing the same tie that's in this photo today at lunch. It's been an interesting couple years, and one that's absolutely been very much, if not necessarily dictated, highlighted by headlines. Right? There's been things that are going on in the Middle East, right? There's been the bank solvency issues. There's been, of course, things going on in the energy market and cutting oil production and how that's affecting the rest of the world. We still have inflation concerns and prices rising. We still have, of course, all the geopolitical headlines that seem to be endless, and it's gone on and on. But the interesting thing about the headlines that you see right here is that these headlines are not from today. These headlines are from October of 1973. The more things change, the more they stay the same indeed. So I was talking to Steve about when Argent started to this very thing. It was September of 1998, middle of September. And I asked him, I said, "So do you remember what happened that year?" And he said that he did, that he knew there was some volatility that year and there were some geopolitical things that had happened and there were some bumps in the road. And he's right. But he didn't remember the specifics. And it turns out that in the month leading up to Argent opening its doors, the S&P fell 20%. In the month leading up to it, we had the Asian financial crisis, ultimately leading to Russia defaulting on their debt, which in turn led to the failure of hedge fund long-term capital management. Maybe some of you remember the book When Genius Failed that was real popular that outlined this whole thing. And 2 weeks later, Argent opens its doors. And there's an important lesson in this. And the one is that Steve definitively remembered that some things had happened, and that's important. We learn from history. But he didn't remember the details. And as an investor, having that memory loss is a really good thing. Because in every single year in the market, every single year, there are things that come up. There always has been. And these are things that sound and are really serious at the time. They're pretty scary sounding headlines, right? Some of you probably remember Y2K when all of that happened, and we were worried that technology was basically going to cease to function. I was living and working over in London at the time, and I was told I probably wasn't going to be able to get home for a while because the air traffic control systems weren't going to work. And maybe some of you remember about 10 years ago, we had the scare with Ebola, right? And and they'd give you this list of those horrible symptoms, and they'd show an interactive map of how quickly the rate of infection could spread. And it really does sound pretty scary, and it makes you ask yourself, should I stay invested? Should I take my money out of the market, or should I stick with it? Because it sounds like things are pretty serious, right? As a matter of fact, at one of the investment outlook luncheons that we had here about 10 years ago or so, we were sitting here talking about feeling pretty good about the market, and it turned out it fell 10% in about 15 minutes in what became known as the flash crash. Maybe some of you remember that. So these things do happen. But I want you to take a look now at the green line that's part of this chart, and that is a chart of the S&P 500 from 1950 up and through today. And there's a couple things to notice about it. And the one is, it is definitively not a straight line, right? It's a little jiggly, it's a little wiggly, and things happen in any given month, in any given quarter, and in any given year. But if you stick with it, long-term investing works. There's been no engine for capital creation like it in history. Back in 1950, if you'd invested $1 of your money and you hadn't been scared out, today you'd have $250. You made 250 times your money if you'd stuck with it. But that doesn't mean that there aren't scary things that happen. There are in every year, right? For instance, you look at this cartoon and the pilots indicated we're going to experience a little turbulence, so fasten your seatbelts. And the guy in the next seat over screams, well, we're all gonna die. And what I can guarantee you is that that's the kind of person who is a financial reporter. And so with that, I'm gonna hand it over to Senior Portfolio Manager Ken Crawford, who's gonna walk you through the state of the economy. Ken?
I'm going to talk about things more global in nature and then move to the United States. And unfortunately, start with the war in Ukraine and the war in the Middle East. And the tragedy and human cost can't be calculated. But for economists, there are another bit of concern, and that's if you think about Russia and you think about Middle East, you think about oil. And if there are wars in those two areas, what does that mean for the price of oil? And I think the knee-jerk reaction would be oil's going up. But if you look more recently, the price of oil has fallen. End of September, $95 a barrel oil, today at around 70. So given those conflicts and given how important those regions are for oil production, why is oil falling? A couple of reasons. The first is other areas are producing oil. So the United States today is the largest producer of oil in the world. We are pumping more than we ever have before. Secondly, what we're seeing across the globe in terms of economics is a slowing. And if growth slows globally, demand for hydrocarbons slows, demand for oil slows. Slowing demand means lower prices. What else are we seeing in the world stage? Artificial intelligence. I'm sure you've heard about it. Big headlines all throughout the year, probably a little bit sick about it. What will it be? No one knows. But even today at Argent, we're playing around with artificial intelligence.
Hello, I'm Ward Brown. Some of you might not know that our firm name, Argent, is actually French for money. La fin de la journée d'investissement est souvent une question d'argent. Nous voulons fournir une mise à jour à nos conseillers et clients au T3. 私たちは特に中豪種戦略ランクのファンドを含むアージェントの4つの戦略で投資パフォーマンスを報告できて嬉しいです。
Currently, we're in the thick of third quarter earnings season with an economy that refuses to buckle amidst higher for longer interest rates, an unexpected war in Israel, and incredible but disruptive innovations like artificial intelligence and weight loss drugs.
So that was a video from Ward. Ward doesn't speak French. Il ne parle pas français. Ward doesn't speak Japanese. Nihongo ga hanasemasen. Instead, Maddie LaBelle, the person who created our slides, used an AI program, took Ward's video and said, make some of it French, make some of it Japanese. and 20 minutes later, that's the result. So think of AI just beginning to hit the stage, and think of what 20 minutes can create. A person who looks like he can speak French, a person who looks like he can speak Japanese, and a person who looks like he has some intelligence. Pretty amazing change. So what about what's going on in the US? Let's talk about jobs. Here's a chart that shows the rate of unemployment. And what you can see is from the pandemic peak, we have dropped nicely. So today, the unemployment rate in the United States is 3.7%. Very strong. In fact, some people are talking about perhaps the resurgence of labor. So what are we seeing when we think of that? So for the first time in a while, we've got strikes making headlines. We had the writers' strike in Hollywood. We had the actors' strike in Hollywood. And for the first time ever, the United Auto Workers collectively struck against the big three automakers. So maybe very low unemployment and lack of people looking for jobs has put some push into labor. And with that, we're seeing an increase in wages and salaries. So this looks year-over-year changes in wages and salaries. And it's going up and to the right. And it's got Donna Summer singing. If you're Fed Chairman Jay Powell, you have two mandates. One of them is employment, the other is price stability. Employment looks pretty good, but that trajectory might have Jay Powell doing something other than singing. Because for the first time in 40 years, we've got inflation in the United States. So when the Fed sees inflation, it pulls out its toolbox and it grabs interest rates. And what we've seen for short-term rates, Fed funds, is they have gone from 0% 2 years ago up to 5.25% to 5.5% today. One of the steepest increases in interest rates in US history. If you raise short-term rates up, not surprisingly, you raise long-term rates up as well. This is a chart of the 10-year Treasury bond interest rate. And what you can see is we were at under 1% in 2020, and today we're at 4%, even given the dip that we've seen recently. One of the reasons why economists pay particular attention to the 10-year Treasury bond interest rate is because it is off of that rate that mortgage rates are priced. So not surprisingly, the interest rate on mortgages are going up as they're following the 10-year Treasury. If you had asked an economist in 2020, when the 10-year was below 1%, what would the housing market do and what would mortgage interest rates do if we went up to 4% on the 10-year? I think most economists would say housing's going to go down the tubes. So is that what we've seen? And the short answer is no. This shows housing starts. And although we're off the peak, we're at a fairly robust 900,000 to 1 million a year. So why is housing doing so well with interest rates and mortgage interest rates rising? A couple of reasons here. Coming out of the great financial crisis, home became a 4-letter word. People didn't want to own a home because they knew if they did, they'd lose money. So they stopped buying homes, and home builders stopped building new homes. So you can see a relatively low new home capacity. Similarly, given the higher interest rates, if you own a home today and you bought it 3 years ago, 5 years ago, 7 years ago, your mortgage rate is very, very low. So while you might want to move, go to a bigger house, go to a different city, the change from what you are paying today with your mortgage to what you would be paying tomorrow with that new house gives you sticker shock and you don't want to sell. So lack of supply of houses has made housing very strong. And actually, if you look across Argent strategies, some of the best stocks that we put into your portfolios are housing related. So I mentioned the Fed's dual mandate, jobs, price stability, and inflation. And what do we see when we look at inflation? This is a chart of the CPI, the Consumer Price Index. And what you can see is in June of 2022, the CPI jumped to over 9%. So we were running about 10% year over year changes in prices, very, very high. So the Fed increased rates. And what happened after that? Interest rate or inflation, the CPI fell. This week, the latest data is 3.1%. So in a little over a year and a half, we've gone from 9% to 3%. Very positive trajectory. But the Fed doesn't want us to be at 3%. The Fed wants us to be at 2%. And there's a fairly aggressive debate within the economic community about how difficult that's going to be from 3 to 2. Secretary of Treasury Yellen says it shouldn't be that difficult. The Fed should start cutting rates. Others think it might be a tough road to hoe. Yesterday, the Fed indicated that they thought maybe they're on the other side of the inflation battle hump, and they could consider lowering interest rates. And it took Argent a lot of work to get the Fed to say that before the Bogey Club, but it paid off pretty well. What about what's going on in the economy today? This chart shows gross domestic product, GDP, all of the goods and services that we produce here, real, so stripping out inflation and the year-over-year growth of that. And what we can see is today we're running at 2.9%, so close to 3%. So for an economy as mature as the United States, 3% growth is pretty darn good. So if you step back and think about everything, what do we got? We've got good jobs, we've got a reasonably strong economy, we've got inflation, and the Fed thinks that it might be taming it. So the 2024 question is, can the Fed engineer a soft landing and make everyone happy? We'll see. The Fed's track record is every time they've tried to engineer a soft landing, they've failed. So with that as an economic backdrop, I'll turn it over to Logan to talk about what's going on with the markets.
Thanks, Ken. I'm going to go off script just a little bit because I didn't expect anyone to actually remember what we'd said in meetings past. But in meetings past, for those that have been here, we've always talked about how Steve talks when the markets are good, and I talk when the markets are bad, and that's just sort of the deal we struck. And I was surprised when I was mic'd up and talking with many of you ahead of this that you're like, well, why do you have a microphone on, Logan? The markets are good. And it's a valid question. And we did have to have a pretty tough conversation with Steve a few weeks back, and we didn't record it, but we did, because the markets have been good, use some of your fees and hired reenactors to show you what that conversation looked like.
Grandpa. Grandpa! Grandpa!
Huh?
I think it's time that we had kind of a difficult conversation with you.
You know how much we love you, right?
Right. And I love you too.
And we only want what's best for you.
Mm-hmm.
It's becoming more and more clear to us that we can't take care of you the way that you need to be taken care of.
Why are you talking like that? I'm fine.
Oh, of course you are. But let's be honest here. You're getting older, and things happen.
You get confused, you forget where you are.
You fall down.
You need to go someplace where they can take care of you.
Where people your age go.
We think it's time for you to run for U.S. Senate.
No! How can you do this to me? I still have a lot of good years left.
So we appreciate that you're laughing. Our big concern was that there was going to be silence, and you were going to think that that was real. We're going to try something new now. We usually get up here and kind of preach to you about our outlook and tell you this is how we think it's going to be. But the truth of the matter is, behind the scenes, we actually fight a lot and we disagree, and we need to, that's part of the process to get to good investment decisions. So what we're going to do now is bring up Jed Ellerbroek, who's our large cap portfolio manager, who'll be representing one side of the coin on 4 different issues, and also Kirk McDonald, who's our mid cap portfolio manager, former Air Force guy. And we're going to tackle a few questions here. Capital Clash 2023. Looks like it belongs on Fox News, right? So first question for you all. What are you all expecting as we head into the new year? What are the things that are on your mind?
Yeah, you're going down, Kirk.
We'll see.
When buying stocks for Argent's portfolios, we're obviously focused on, the company by company analysis. So like Home Depot versus Lowe's, for example, who's got the better outlook over the next 5 years? But when you look at the stock market as a whole, we think investors are going to pay a lot of attention in 2024 to the election season that's coming up. I promise to keep this neutral. My mom told me to never talk about politics in public, but I'll make it quick. So the stock market cares a lot about the upcoming election. Both parties think they have a chance to control both the presidency, the Senate, and the House. They're close to 50-50 today. And so, it's an especially consequential election coming up. And we thought we'd kind of mention a couple areas that the stock market is going to be particularly focused on. Number one, tax. The Trump tax cuts expire in December 2025. The stock market liked those tax cuts quite a bit, obviously. Lower taxes equals higher profits. Number two, energy policy and just kind of, fiscal policy, generally speaking. Democrats and the Biden administration passed a variety of renewable energy tax credits and incentives that the utility industry and the industrial sector have really benefited from, while the Republicans, focus more on traditional fossil fuel incentives. So drilling on public lands, drilling offshore, stuff like that, just kind of different priorities. 3, tariffs. The Trump administration used tariffs pretty aggressively as a trade policy tool. We put tariffs on our foes, China, but also friends, Canada and Europe. Those affected a lot of industries in surprising ways. For example, the steel tariffs really benefited United States steel companies, but harmed the companies that buy that steel and turn them into products. So John Deere, Caterpillar, the RV industry, et cetera. And then 4, regulation. The Trump administration, largely pursued a deregulatory agenda with the EPA, with the banking industry, et cetera. The Democratic administration, currently has been raising those regulations in all those areas, but another one that they've targeted is mergers and acquisitions. So deal activity in the economy the last few years has really declined because the FTC has challenged a variety of mergers and acquisitions and made companies a lot more cautious to pursue that strategy. So you can see, industries are going to be really focused on what's coming with us, or what's coming in the next year, and who's going to be in control. Kirk, what are you watching?
So Jed talked about a whole bunch of big picture macroeconomic ideas that are impacted by the elections in 2024. But he also mentioned that we're bottom-up stock pickers looking for the best enduring businesses that we can find for your portfolios, because these are businesses that have weathered all kinds of political cycles, all kinds of economic cycles, and withstood the test of time. So I've been much more focused stock by stock, just looking at opportunities that the market's handed us in 2023 and will benefit from it in 2024. One area is healthcare. Healthcare really had a tough year in 2023 compared to the rest of the stock market. So we recently added to a long-term holding in the mid-cap portfolio, Argent Technologies, ticker symbol A, and they make precision instruments that are used in the pharmaceutical sector and for biotechnology research. You might have heard that last week there was the very first gene-edited therapy was approved by the FDA, and it treats sickle cell anemia. So it's the first cure actually for sickle cell anemia. And it's Argent Technologies precision instruments that enable that CRISPR technology, that gene editing technology to happen. Biotech funding, really, they had a boom in 2020, 2021, when the COVID vaccines were being investigated, and there was just a lot of easy money and good funding for biotech. Went through kind of a hangover in 2022 and 2023, And Agilent Technology stock fell 38% this year, which we think is unwarranted because there's still a huge need for their instruments and a lot of research coming along in biotech, and we see that funding starting to increase. So we added to Agilent Technologies. Another area is trucking. We recently added a trucking company called TFI International, ticker symbol TFII. And trucking, as you know, is a very cyclical industry, very dependent on where the economy is headed. But TFII has been in business since 1980 and weathered all sorts of economic up cycles and down cycles. And we think as the economy improves at some point in the future, that TFII will be a really good long-term holding for us as well. So that's what I'm focused on, is really bottom up, taking advantage of the opportunities the market hands me.
So my favorite question for cocktail parties: which industry will be most impacted by the weight loss drugs?
Okay, so
Go ahead, Kirk.
I get to go first. You said letting the old guy go first this time instead of the young
Absolutely.
whippersnapper who thinks he knows everything. So I'll take a step back before I tell you what industry I think is going to benefit, and just explain the weight loss drugs in case folks aren't really aware of what's been going on recently. But the pharmaceutical companies developed a type of drugs called GLP-1s. They're GLP agonists, and that's as technical as I'm going to get. If there's any medical professionals in the room, they can get more technical. But these GLP-1 drugs stimulate the production of insulin in the body, and that actually helps treat type 2 diabetes, the most common form of diabetes in this country that afflicts millions of people. A side effect of these drugs, though, was that it reduced your appetite and gave you a feeling of fullness. So people ate less, and they were losing weight while they were on these diabetes drugs. So the pharmaceutical executives, they're a pretty savvy bunch, right? They like to make a lot of money, and they thought, there's millions of people with type 2 diabetes, but 70% of Americans are overweight. So 250 million people could actually benefit from a pill that will help them lose weight. And then they remembered back in the late 1990s when they were working on high blood pressure medicine that actually made your blood pressure smaller, but it had a side effect of making something else bigger. You may remember it was a little blue pill that came out in 1998, and that turned into a giant blockbuster for those guys. So they're thinking these weight loss drugs could be a huge blockbuster. They're thinking the market for those is going to go from $0 a couple of years ago to $70 billion by the end of the decade. So it's potentially huge. And there's 3 that have been approved so far: Wegovy and Ozempic from Novo Nordisk, and Pfizer has one called I always forget.
Zepbound.
Thank you, Zepbound. See, Jed's going to get it as soon as he can, so he knows. But this is potentially a big deal. So Walmart has done a lot of studies on this because they're concerned how it could affect their food sales. They found that people on these drugs, they consume 20 to 25% less calories, and it eliminates their food noise, meaning when you're walking by and like a donut shop and you see the donuts in the window and you get hungry because you know that's going to taste good. That's food noise in your brain. These drugs eliminate that desire. And people eat 60% less unhealthy foods like confectionery snacks, sugary beverages, salty snacks. That goes down by 60%, but intake of fruits and vegetables goes up 40%, and intake of fish and poultry goes up 20%. So I think these weight loss drugs have the potential to negatively impact unhealthy food companies the most. Jed, what do you think?
Yeah, great answer. Medical devices are also going to be impacted by the advent of these drugs. So today, 1% of America takes, one of those 3 drugs that Kirk mentioned for weight loss purposes.
Sorry, could you repeat that?
Yeah, 1%. 1% of America today is taking one of those drugs for weight loss purposes. That number is going to go up quite a bit in the future because health insurance coverage of the drugs is pretty modest today and is going to be increasing a lot. For example, Medicare doesn't cover these drugs for weight loss purposes currently, but probably will in the future. Also, additional drug companies are going to be introducing drugs with similar strengths in a pill form as opposed to the current injectable options. So that's going to increase adoption as well. More people using these drugs means people will have, obese people will have the option to, they'll have a substitute to the variety of procedures that you'll see listed here. These are a bunch of kind of tools, medical procedures that are available to people that are obese. This was the choice. These were the choices, for those folks. But in the future, they will have the option to, perhaps take a pill that would allow them to lose 20% of their body weight and avoid a lot of the harmful side effects and consequences of these procedures. Laying in bed for a week, having to, only have liquids for a week, etc. So, and actually, you're seeing, for example, gastric bypass surgeries, they are already declining as people investigate the options and see, do these drugs work for me? Is it an option for me? So you are going to see less usage of these procedures, I think, going forward, and that's going to impact medical device companies really across the spectrum.
I don't know if I get to be the judge, but I would vote for Kirk on that one. The thought of people actually eating less food in America, I don't know. That seems a little hard to believe, but that was my favorite question. That's really fun to talk about at cocktail parties. Less fun at cocktail parties is the number one number one question we're getting in client meetings. By year end 2024, are we in recession?
I'll take that one, Logan. And most people that know me would say I'm an optimistic person. When I look at a glass of water on the table, I'd say that glass is half full. But when it comes to the economy in 2024, I'm thinking it's half empty. Few things have me pretty concerned about what's going to happen. The first of these things I'll talk about is the leading economic index. So it's the most well-known index that leads the economy by about 6 to 8 months. And its track record goes back to 1960. Currently, it's down 12% from the all-time high. It's set way back in April of 2021. Currently, it's down 7.6% from where it was a year ago. It's never fallen this far without us having a recession. So what the LEI is telling me, it has me very, very concerned. The other reason is the Federal Reserve. And we've been talking already today several times about how the Federal Reserve's raised their interest rates farther and faster than they ever have before. And there's two reasons for doing that. One is, number one, bring down inflation, but number two was to slow the economy down because it was overheated. And so 11 times since 1948, the Federal Reserve has raised interest rates with the idea of slowing the economy down just enough so they avoid a recession. And their track record is perfect. 11 for 11 and causing a recession every time. They're always late to the punch and lowering interest rates. So most likely they'll be late again, because when it comes to soft landings, they're 0 for 0. They've never pulled off a soft landing, meaning they've never raised interest rates and slowed the economy just enough to avoid inflation and then lowered interest rates so the economy can take off again. I think most likely we're going to crash and burn. So Jed, what do you think?
Kirk, I have a question for you. So yesterday, the Federal Reserve had a meeting. They had a press conference afterwards, and they told us that they are intending to engineer our first soft landing ever. And the way they're going to do that is by cutting rates more proactively than they have in the past. Are you a believer?
So I heard Jay Powell say that, and I thought to myself, well, Jay, you and all the other Federal Reserve presidents before you can talk the talk, but you can't walk the walk. I don't think so.
Okay. I think that we should choose optimism. And the reason why, I guess, first of all, the next slide. It shows you economist projections of GDP growth this year, 2023, and next year, so the next 5 quarters. And you can see they're projecting that we will achieve this mythical soft landing that we've never achieved before. Why is that? I think the main reason why is because COVID messed up a lot of economic relationships and patterns. Instead of one synchronized recession where most cyclical industries, experience a downturn and then recession, all at the same time, I think what we're seeing instead is a kind of rolling recession. Let me give you a couple examples. So in 2022, digital advertising had its recession. So I'm talking about Google, Facebook, Pinterest, etc. Digital advertising spending declined year over year for the first time ever. That was their recession. Why did that happen? It happened because we all shopped online in 2020 and 2021 to an extent like we never had before. And then in 2022, we resumed vacationing and going to physical stores. And so that digital advertising kind of declined in sympathy with our behavior change. Another example, this year, 2023, the drug industry is having its recession. Why? COVID caused drug spending to increase dramatically. Human interest, government funding increased significantly for drug development in 2021 and 2022. And now we're in kind of like that COVID hangover phase for the drug industry. Spending is declining, demand is weakening. Fewer of us are taking COVID vaccines, etc. Next year, 2024, it looks like non-residential construction is going to have its recession. It's going to decline year over year. I'm talking about spending on office buildings. We don't need as many of those as we used to. Retail stores, same thing. So instead of one synchronized descent into a cyclical recession, it feels like we are having a rolling recession of sorts, and the overall economy seems to be hanging in there well enough that we can land this plane softly for the first time ever.
All right, we'll see. And final question, which industry will benefit most from artificial intelligence?
Yeah, this is an easy one, guys. Semiconductors is the answer. They are the brains of the digital age. They are what enables this artificial intelligence revolution that's begun here over the last 12 months. NVIDIA is the company that many of us have heard of. It's kind of been a stock market darling over the last few years. They make these very advanced processing chips that allow really, really rapid calculation, and it allows for ChatGPT and Google to give us, answers to complex questions, for the first time. All of NVIDIA's peers and competitors are now racing to try to develop chips that are this capable. So I'm talking about companies like AMD, Intel, even Amazon, Microsoft, Google. Those companies are all racing to develop chips this advanced or more in the future. If you look at this next slide, you'll see green is the semiconductor index. So it's like a combination of all semiconductor companies. Red is the S&P 500. Obviously, it's been a great year for the market. And one of the best performing industry groups is that semiconductor group, led by NVIDIA, but also a whole bunch of other companies, many of which Argent owns. So, Kirk, are you sure you want to even answer this question, or do you want to give me the...
Actually, your answer was frighteningly and suspiciously good. I think you had ChatGPT right. There's no way you could have come up with that answer. So it's hard to argue with that. I actually don't disagree with Jed, even though he's been wrong on all three points we've argued. Completely wrong, by the way. This one I agree. But I think what's going to happen is several different industries will benefit in waves. And this has typically happened. We have this artificial intelligence revolution going on now. More recently, it was the cloud computing shift. Before that was the shift to mobile computing. What you've seen is things happen in layers. The very first layer is the compute layer or the infrastructure layer, which benefits companies like the semiconductor companies or large companies like Microsoft and Amazon and Google that own the data centers that connect the thousands of computers together you need to make these artificial intelligence programs work. So that compute layer benefits first, and we own several of those companies in our portfolios. We own Microsoft and Dividend Select in large cap. Right there, we own Applied Materials in large cap. They actually make the equipment to make the semiconductor chips. And we own Integris in mid cap and SMID cap, and they make the materials that go into the chips themselves. And on average, those stocks are up 60% this year. So that's the first layer. The second layer, I call it the data layer. So it's the consulting companies that teach you how to use these programs to run your company better, and they actually write the programs for you. So it's companies like Accenture that we own in Dividend Select, Booz Allen Hamilton that does government consulting. We own in large cap, mid cap, and SMID cap. And then a local company called Perficient that does technology consulting that we own in the small cap portfolio. So companies like that will benefit second. And on average, those stocks are up 32% this year. So a good year, but not as much as the semiconductor and Amazon, Google type stocks. The last layer is the people layer. You actually need talented people to run these programs within your business and keep them maintained. So that is companies like E+ that we own in the small cap portfolio, Assign Incorporated that's also in small cap, or Gartner that we own in mid cap and SMID cap that provides advice on how to use this artificial intelligence and which software to pick for your business. And those stocks are up about 25% this year, so not as much as the other two, but I think it's going to happen in a wave where these multiple industries and the tech space will benefit. That's my thoughts. So,
thank you both. Let's hear it for our contestants. I did want to take a second to clarify things on AI that these two didn't mention. We do think that artificial intelligence is going to be a game changer, just like how the internet was a game changer. But similarly to the internet, it's going to take a long time for everything to roll out. It took 20 years for the internet to change our communication methods, how we shop, how we consume news, how we order food. And we think this is the early innings, maybe the top of the first of the changes that are to come in artificial intelligence. To give you a few reasons or a few things that will happen to Argent is Microsoft right now, one of our largest positions for the people in this room, is rolling out slowly Microsoft Copilot, which is really incredible because if you never learned how to use Microsoft Word or Microsoft Excel or Microsoft PowerPoint, congrats, you were the smart one, you never needed to learn how, because what you can do now is literally talk into it and say, Microsoft Copilot, write me a 3-paragraph summary of why performance has been good and I did well at the Argent Outlook, so Steve, give me a raise. And it will write you that paragraph for you. And then you can say, okay, take that and put it in Excel and show the percent increase, and it will do the things for you. And then you say, now, Steve likes fancy presentations, so put this into a 3-page PowerPoint using the Argent colors. And it can literally generate those things as you talk to it or type into it in a very, human-like manner. So Steve never did learn to use Excel. He was one of the smart ones. I have a feeling there's a few other smart ones in here as well. And it is going to save us a lot of time and energy in the past or in the future. We did want to talk about year-to-date performance because it has been good. So we snuck it in here at the end. Our large cap, and these are all net of fees, large cap strategies up 25% year-to-date. Dividend Select, our more conservative, higher cash flow paying strategy, up 10. Mid-cap, stellar performance, up 25%. Depending on the time period, Morningstar says it's number 1 or number 2 in its category. And then we have Focus Small Cap, up 18%. So it really has been a tremendous run, and we appreciate the confidence you put in us, and we hope to continue this going forward into 2024. Have a great holiday. Happy New Year. Thank you for your business, and we appreciate it.